The world's greatest geologist is on the verge of his next billion-dollar discovery. With looming shortages in copper, zinc, gold, and silver, this may be the best opportunity hard asset investors have ever faced. Learn more at futuremoneytrends.com/hardassets.
Hello everyone, and welcome into crushthestreet.com. My name is Kenneth Amaduri, and today we're joined again with Steve St. Angelo of SRSrocco.com. We recently had him on, and we focused more on oil last time, but today we're going to talk about silver. And Steve, first of all, thanks for coming on the show with me today. How are you doing?
Great, Kenneth. It's been a good day, starting off to a good day. We finally hit $16 silver today, and it's been a while since we've seen $16 silver. It's been floating the 14, 15 range for almost most of the year. So it's a small little victory, but it's just the beginning stage of much bigger things to come in the future.
Yeah, it's definitely a move up. I mean, from $14 up to 16, we're looking over a 10% growth in the market. So for sure, we're seeing some forward momentum with that. But sticking with silver, Steve, I'd like to start off with the Comex. A lot of people hear news about the Comex, and we've gotten accustomed to go, wow, this is important. This is an issue. But I feel like a lot of the people who are listening to this don't exactly understand the Comex, know what the Comex is, and understand why it is an issue if you are investing in silver, why it's important to analyze. So can you just kind of give us a brief understanding of what the Comex is and why it's important for silver?
Okay, Kenneth, that's a good question. And let me start off by saying that the Comex used to be the delivery mechanism for the silver and gold market. It no longer is. However, it does provide us some guidelines and some trends of what's happening with their inventories. It seems to be that the Shanghai Futures Exchange as well as the Shanghai Gold Exchange are now more physical exchanges where people can take contracts and they can take delivery, and they're taking a lot of delivery of gold off the Shanghai Gold Exchange. So now the Comex has two categories of metal. There's eligible and then there's registered. Both the gold or silver adheres to the Comex rules and regulations of what is a standard bar for the Comex. And it's 400 ounces for gold and it's 1,000 ounces for silver. Now, the difference between registered and eligible, you can be a big investor and you hold your silver at one of the Comex depositories. And you don't want to sell it into the market. So you're in the eligible category. Now, if silver wants to be allowed to be delivered into the market, it has to go into the registered category. And then the registered silver or gold is actual metal in the Comex depositories that's available for delivery into the market. And there's a lot less registered than is eligible. And so that's basically the difference between the two eligible and registered. Now, what's happened, and let's focus on silver. If you remember back in 2011, when the price of silver really jumped, it jumped from, I think it was $17 in September to $50 in I think it was May of 2011. Now, the interesting thing there was that during this time, we saw a drawdown in registered silver inventories. They went from like 56 million ounces down to 26 in about a year and a quarter. Now, what is important, Kenneth, is that this was a drain of about 1.8 million ounces a month. And so the registered got down to 26.7 million in about July of 2011. And then we had the price of silver collapsed. And then in 2012, it kind of hemmed and hawed around 30, and then it continued to fall into where it is recently. Well, over the last 4 years, the registered silver inventories have increased, and they peaked in April this year at 70.5 million. Now, what's interesting now is that since April until the end of September, the registered has fallen almost more than 30 million ounces, and it's fallen at a rate of 5.3 million ounces a month. So The difference is, back in 2010-11, there was a lot of industrial demand because the markets were actually still growing. China was importing a lot of silver. Industrial demand was still growing. Now, this time it's different. We're seeing a much larger and much faster removal of registered silver, and I think most of it is due to investment demand, as industrial demand is likely falling off because of the economic activities falling off. So I hope that gives your readers and listeners some idea of what's happening. And right now, just to give you an example, at the last update, the registered silver categories at the Comex were 43.5 million. So it just goes to show you, in just 5 months, we've lost that much silver. And so if it continues on this, it'll be interesting to see how that impacts the silver price and silver market.
You gave us a great example of right there and a good understanding of what exactly is the Comex and why it's important for us to follow. So sticking with the silver vein here, I want to ask you, Steve, you've written about record amounts of silver being bought. Today, as silver is crashing, as silver has gone from close to $50 in 2011 down to $15, $14 that we've seen now back up to $16. We're seeing record amounts of buying happening. So tell us a little bit about this. And one thing that I do want to point out, and maybe you can comment on it, is it possible that we're seeing more ounces because the price is lower? So dollar amount, when silver is 30, you might have a certain amount of buying, but that same dollar amount at 15 is double the amount of ounces. And maybe you can comment on that as well. Are we seeing this record amount, and is that being taken into consideration when doing these calculations?
Okay, those are good questions. Of course, when you're buying silver at $35 and now you're buying silver at $15, you can buy twice as much silver, but the dollar amount is not going to be any more. It'll be about the same or less. Now, what's interesting, and this is important for silver investors to realize, I went back to the Silver Institute and looked at some data. Now, this whole thing is an ongoing trend change that started in the 1960s when the U.S. demonetized silver. And the reason why they had to do that was industrial demand had skyrocketed so much, and coinage had increased so much there wasn't enough silver. And the U.S. government realized in 5 years there just wouldn't be enough silver, so they decided to take silver out of the coins. Well, a lot of this silver, because investors, Americans, knew the price of silver was going to go up, they started hoarding it. So what we know as junk silver, a lot of investors or Americans started to hoard all this silver that was our official coinage. Well, in the 1970s, the price of silver went from $1.50 in 71 to about $5 plus by 1978. It hadn't really spiked yet, but these are average annual numbers. So what happened is, what's interesting, during that time, there was a huge deficit, a cumulative deficit of 400 million ounces. Well, Americans actually sold silver, junk silver, into the market and supplemented the market, like 600 million ounces. So during that price rise, Americans were selling silver. The people who were buying it were the Hunts and other institutions on the back of higher skyrocketing oil prices. Now, the public came in 79 and 80. That's when the price of silver jumped to $50. That's when they came in. Then the price fell in 80, 81, and the beginning of 82. Matter of fact, Kenneth, it got down to $5 in June of 82. Well, there was actually a financial panic that they thought we would see higher inflation going forward, so investors started purchasing silver again in 82 and 83. And during that year and a quarter, it jumped up to $15. And so at those two brief periods, the public came in and actually became net purchasers of silver. Well, over the next 2 decades, it went nowhere, really. Now, the difference today is from 2008 to 2011, we saw the price of silver actually skyrocket. And in that time, silver bar and coin demand was like 630 million ounces. So investors were buying a lot of silver as the price went from like $10 to $50. Well, this is what's even more interesting. From 2012 to 2015, it's going to be 820 million ounces. Investors are actually buying more silver on the way down than they did on the way up. And this is much different than the buying periods in the 80s when they were buying silver on the way up. So what that tells us is Americans, North Americans, and Indians, other investors, realize nothing has changed in the financial system. So even though that price is falling, they see it as a great deal. And that's why we continue to see record buying. And let me give you one more statistic. You asked about Silver Eagles. This is what your listeners need to understand. During the shortage in 2008, when we had a huge shortage in premiums for Silver Eagles, were almost double. If the price of silver was $9, you were paying like $7, $8 over spot to get a Silver Eagle. Well, during June to September 2008, the U.S. Mint only sold 6.1 million ounces of Silver Eagles. If we take the same shortage that's happening recently from June to September, Kenneth, it's 18.8 million ounces. We're having a product shortages with the market supplying 3 times the amount of silver that it did, products that it did in 2008. This is what people don't realize. They see a shortage in 2008. Well, we have another shortage this year, but it's 3 times worse. So, yes, there are product shortages, but what I found out from talking to dealers, and this part of our interview, that wealthy people are not purchasing big bars. They're not buying 1,000-ounce bars. They're not even buying 100-ounce bars. Some are. But it seems like when someone calls the phone and talks to a dealer and they want to dump 6 figures, $300,000, they're buying Silver Eagles, Canadian Maples, or the new Kangaroos or Britannias. They're not buying the 100-ounce bars, the 1,000-ounce bars. That's why we're seeing so much pressure on the products, on the silver official coins.
So when it comes to the shortage, Steve, you kind of alluded to it, but I'm wondering, is this just something that the dealers are dealing with from a short-term perspective, or is this something that the industry as a whole is going to have a hard time dealing with long-term, and will this eventually affect the price? I mean, you're talking about record amounts of buying, and over the last few years, we've just seen the metal drop and go further down. And maybe you can comment on your opinion as to why we're seeing it fall substantially over the last 4 years, with the exception of the last month or so and periods in between where we've seen spikes up. But overall, the trend has been down. Maybe you can comment on why we've seen it go down, and then also this short-term versus long-term shortage and how that will impact the silver market down the line.
Well, we all know the markets are manipulated. We know China's buying stocks, Chinese government's buying stocks. We know Japan, they publicly say it, that they're buying stocks. Heck, the Swiss government actually owns 10 million shares of Apple. I mean, so we know the U.S. government is doing the same thing. So the markets are being propped up. What's being propped up is the bond and stock market.
Right.
What isn't are the commodities, and they don't want the commodities to be propped up because they want lower commodities, lower inflation. So the bellwether of the dollar, barometer of how good the dollar is doing is our gold and silver. And so it's important to keep those out of the public's understanding, because if we just had a doubling of investment demand of silver, it would totally destroy the market. Just a doubling of where it's now, from 1% to 2%. It would destroy the market. However, also silver is being traded kind of the way they have the algo set up is based upon the price of oil. Now, the price of oil has fallen. So if we look at what the primary silver miners are producing silver, they're producing silver now at around $15, $16, $17. So seeing silver at 14, 15 isn't unheard of. But what makes it unheard of, or what makes it not right, is that there's all these assets out there that aren't worth the money, the stocks or bonds. So when the world realizes those assets aren't really worth it, and we start to see an implosion, that's when we'll see people moving into gold and silver, and their value is really skyrocketing. However, the silver demand right now, is this a short-term product shortage? Well, we experienced it in 2008. We also experienced it in 2013. And both of these spikes were due to lower prices. Again, if trying to tell you the difference between now, Americans weren't buying silver on the way down back in 80 and 79 and 80, and they weren't buying silver on the way down in 82 and 83. They were buying it on the way up. What we're seeing now is very increased buying, and on the way down for 4 years. I mean, it's like unprecedented. And it's now, I'm hearing wealthy people are buying silver more than gold, and they're not buying the bars, they're buying the official coins. That's why we're seeing a shortage in official coins. And lastly, the United States is importing more silver this year, 21%, 600 metric tons, and the market doesn't dictate it. And so something is very strange there. Now, I looked at U.S. silver imports for manufactured, let's say, industrial fabrication. And if we're talking unwrought silver, silver powder, semi-manufactured silver forms, imports for the first 7 months of the year, Kenneth, are down between 50 and 60%, 5 to 60%. They're down. But our bullion imports are up 21%. So it looks as if people, large investors, as well as the silver market, is purchasing a lot more silver investment demand. And we're seeing it right now in the product. There's no shortage in the wholesale market, but the shortages are in the product. And we've had these tremors since 2008, this huge spike in let's say, product or silver investment demand. I think we're leading to the major earthquake, and that's what all this is kind of trending towards. Again, we would need much more buying to totally wipe out the market right now in silver. So I think longer term, we're going to see problems in the market, whether it's financial turmoil, or it's going to be more market crashes. Once these start to occur in a larger way, investment demand is just going to pick up because I hear more and more new buyers coming in. And so if we're having tightness now of product, this is what I spoke with Doc about. Even though you can still buy silver from the dealers, Kenneth, the dealers have stocked up on silver product. The wholesalers, not the wholesale market like the exchanges that have the 1,000-ounce bars, but the wholesalers that actually acquire a lot of the silver products that they get from the mints, they're wiped out. So we could continue going to October and November, and the dealers will still have inventory, but they have wiped out a lot of the wholesalers. Like the Sunshine Mint, they're not offering any new, they're not taking any new sales until the end of December 2016. So
I was going to say, are we seeing this reflected in the premiums? Have you been able to chart like what the premiums have looked like with silver at $14 and now at 16? But have you done any research on what the premiums have been doing during this shortage?
Yeah, according to ShareLinks, and they do a good job, Nick Laird over at ShareLinks, he has a chart that shows up until recently, the overall Silver Eagle premium is 25%. Mm-hmm. Now, some places it's higher. It may be 30 to 40%, depending on the wholesaler. Now, the premiums are not the dealers. The premiums are not the U.S. Mint. The premiums are the wholesaler. Now, some people say, well, I don't see no shortages. I can go to APMEX, and I can buy silver at APMEX. I can get Silver Eagles, and there's not much of a wait time. Well, APMEX is an exception. They buy directly from the U.S. Mint. They're one of the 11 authorized dealers. Well, I talked to some other dealers who are more private, and they have wealthy clients. They sold out of all their Silver Eagles, and they can't get any more from their wholesaler because the wholesaler has basically sold forward all their allocations for the next 2 months. So it depends on the dealer. depends on the wholesaler, but premiums are ranging from 25% and higher. And I haven't seen we won't know the most recent change with this price at $16. But again, I think what investors need to realize, the dealers, when they saw what was happening, they went in and bought a lot of product from the wholesalers. So I think the largest wholesaler in the U.S., according to Doc at SilverDoctors, they only were selling 3 products. That's all they were selling: Silver Eagles. They were selling, I believe, the Kangaroos and the new Asahi 100-ounce bars, and that's the only product they're selling. So it just goes to show you the largest wholesaler in the United States is down to selling 3 products.
That's amazing, and that really exemplifies where the shortage is, because, sure, a lot of people are hearing the news about the silver shortage, and then they go online and they're like, oh, well, there it is, and it's not selling for $50 an ounce. It's available, but you're showing how it's basically you're buying pre-bought inventory. It's sitting there, it's available, but this could break soon. Any thoughts on when this could break, Steve?
You know, that's a $64 trillion question. And what I think from when the U.S. demonetized silver, and then all this silver went in to feed the industrial machine. A lot of silver went into industrial manufacturing. I think it's been a 5-decade trend, and we've been working through what is known as unreported silver stocks. And they've been really drained, especially in the last decade. Do you know, in the last 10 years, according to official data, and this may be underestimated, that the cumulative deficit from supply and demand is 1 billion ounces. So we had to get 1 billion ounces somewhere to feed the silver market. And it's probably come from above ground, unreported above ground stocks that are continuing to deplete. So I think that's the reason why silver and gold need to be, they need to be manipulated. I mean, some folks don't believe in that, but they have to be. Because if we just saw a doubling of silver investment demand, because Americans got worried, and they are. And let me tell you, I hear more and more people who would never buy silver, they're buying silver now. Mm-hmm. So, and this is still a small percentage. If that just doubles, there won't be the silver available. So I think going forward, we are going to have a market crash at some point. They just cannot continue to prop up. I mean, the economic data, as you read, it's becoming worse and worse. But the Dow it seems to gravity. It's amazing. It keeps going up while the indicators keep going down. And so at some point, this is going to crack. And I think it's going to make its way into the financial markets as well. And I think it will happen between this fall and next fall. It'll start this fall, and it'll just get worse throughout the year. So I think within the next year, we could see a seize up of the silver market. And I think at some point in time, when physical demand reaches to such a level, it will destroy the paper price.
Yeah. Well, it's interesting how the paper price, and it's being manipulated, trickles over to the physical price, because obviously the manipulated paper price gives this idea of what the physical price should be. And even though the physical should be much higher, it's still very, very cheap. I mean, with just a 25% premium on the Silver Eagles, we're not talking about a very, very expensive Silver Eagle at the moment, which actually reminded me of a question I had. What is the historical premium for a Silver Eagle, and why, and how much higher is it compared to that at the moment?
Well, the U.S. Mint was, I think they raised it, but they were selling a Silver Eagle over $2 over stock. Okay. And so, depending on what the price was, if you were buying Silver Eagles at the $30 price, then $2 is it's a very small percentage of that. But it seems like it's been running between a 5 to 8% premium. Okay. That's what's normal over the average without any spikes. That's where it tends to. That's where it has been. And gosh, let me inject this that we were talking about it, and maybe I might have lost my train of thought. But you see, investors need to realize how quick the market can change on a dime. In 2007, AIG, and that was one of the largest insurers in the world, private insurers, AIG went from $1,150 stock price in 2007, and it went to $30 in 2008. Bear Stearns was a $90 stock, and within no time, it was selling at $2 before it went under. Fannie Mae was the same way. It was a $75 stock. It became a penny stock. So what happened, it's amazing how these companies that were thought to be so valuable, and that's what the Main Street press was putting out, and there's all these reports and all this guidance. Well, AIG is going to go to $1,200 a share. Well, it plummeted. Well, this is the exact opposite. That's what's going to happen with gold and silver and the mining shares. The exact opposite. Everyone thought, well, the metals aren't worth anything. Well, the value is there. The market, the overall market doesn't realize it. The 1% do, but the 99 don't. And so we're going to see the exact opposite from Lehman Brothers, Bear Stearns, AIG. It's going to be the exact opposite with the gold and silver market going forward.
Yeah, it's an amazing point, and it always blows my mind when I think about the 2008 crisis with the real estate and seeing home prices that people were and realtors were saying, oh, they're going up in value. You can get a great interest rate. I mean, I'm talking 2004, 2005. The market's great. And there was a demand for it, and it was going up. So it makes sense that it's worth whatever it's selling for because the buyers, the sellers create the price. But as soon as that sentiment shifts and people are no longer willing to pay that price or can no longer afford to pay that price, the market just absolutely crashed. And you bring up an amazing point on how the stocks did that and how we can very well see that happen with precious metals and silver in particular. So to wrap up and talk about the last big wild card, the government, the Fed, what do you think is going to happen with QE4? Are we going to see QE4, or are we going to just see more artificial suggestions to rate hikes down the road? And could this be the breaking point for the stock market? Do you think they'll eventually lose control of it, or where are we going to see that breaking point happen in our markets, Steve?
Yeah, I think a lot of it also depends on China and Russia's timing with the BRICS to design this go around. And from what I understand, listening to other analysts, they're working harder now. And they started doing this in 2008 when we got on this huge QE, the Federal Reserve got on this huge QE monetary, basically printing money and buying bonds and stocks. And so it's one thing if you're a banana republic, you can do that. But it's another if you're the United States and you're the dollar reserve currency. And what happened when the Fed dropped interest rates to zero, a lot of countries around the world, especially the BRICS, they borrowed dollars and invested money. Well, in the last year and a half, when the prices of oil have fallen, a lot of the producing countries, their currencies, and you know this, their currencies have been pummeled. So now, if they borrowed $5 billion in U.S. dollars, the dollar has appreciated against their currencies. They owe even more now, and so it's a disaster for these BRIC countries and producers, China and Russia. So they're trying to do a workaround the U.S. dollar, and we know this is happening on a quicker basis or a more rapid basis because look at Russia is now in Syria, and so is China. And so you don't just have Russia in Syria trying to protect what they see as a disintegration of the Middle East due to, as they see, U.S. involvement. The United States has gone in there and basically totally destroyed a lot of countries in the Middle East, and it's very unstable. So if you had just Russia going in there, Kenneth, it's one thing, but you have China in there as well, and they want to stabilize this area. So I think we're going to see more treasuries taken out and sold into the market to purchase gold by the Chinese, and also to get their Silk Road system of trade away from the United States, away from the West, more into Asia and Europe and Russia and the Middle East. So I think at some point in time, the Federal Reserve will lose credibility. The dollar will lose credibility. There could be devaluations. We just don't know. But I don't see this as a 5-10 year event. I see this as a 1-2 year event. And so I think investors, if they haven't purchased some physical protection, gold and silver, and they're still in the markets, gosh, it's going to be very depressing to see the U.S. actually become a third world country once the dollar loses its reserve currency. So, in a nutshell, I think we're going to see a increase in volatility going forward, especially over the next year or two. And I think we just get one black swan event. It's a totally different market by that point in time.
Total game changer. But what happens when other countries fold and then they rush to U.S. dollars? Doesn't that extend the life of our prosperity as the U.S. every time that happens? And you bring up an interesting point about a strengthening U.S. dollar and what that does to the country's abilities to invest in the country. But I'm curious as to your thoughts on when other countries have problems and then they rush over to the U.S. and then how that propels the U.S. into further prosperity before we actually do realize a collapse or a crash.
Well, I think that's been going on for quite a while, but I think we're getting to the point now, and you look at the Treasury tick data, and you're not seeing continued purchasing of U.S. Treasuries by most countries. Certain countries are, and I think they're actually propping up the Treasury market. But I think that is wearing out. Even though the dollar is better than every other currency, it's also destroying the BRIC countries' currencies, as well as their ability to get out of this mess. So I think what's happening is we're seeing more and more. They're working with the Chinese and the Russians to this workaround, and we're seeing more evidence of that. So I think we're going to see, as time goes on, we're going to see less countries going into the dollar because they have to, and they're going to start moving into this BRIC, China, Russia workaround, the U.S. dollar. And we're talking, gold trade notes. And Jim really brought this up. The West controls the currency, and they also control the bond markets, but they don't control the trade, because 60% more of the trade now is being done through these BRIC countries. Do you know that only 2% of the Chinese yuan or renminbi, 2% of global trade is in the Chinese yuan.
Oh wow!
60% is in the U.S. dollar, or 65, and then the rest is either in Japanese yen, in the euro, or the pound. So, and then nothing is in the ruble.
A slight move could be devastating.
A slight move could be devastating. It won't happen overnight, but I think the volatility will increase. And at some point in time, I mean, look at some of these stocks that are getting killed in the markets, and the Dow goes up. Yeah. It defines gravity. It defies gravity, really. And so I just think as time goes by, and I don't think the Chinese and the Russians are ready yet with this system, but I think that I don't think this is a 5-10 year process. I think this will occur within the next several years. Yeah. And most likely it could happen within the next year.
Everyone, that's Steve with SRSrocco.com. Steve, I really appreciate you coming on the show with me and just having this conversation. Anything exciting going on at your site lately that you want to share with our audience?
Well, we're adding I'm working on some new reports, but we try to put out 2 or 3 articles a week on the silver market, gold market, and energy. And just to let your readers know, one little tidbit here. Yeah, something interesting is the U.S. shale production has peaked. And according to the official source, the EIA, overall production peaked in June, July, and that was 9.6 million barrels. We're already down below 9.1. We're down 500,000 barrels. And have you heard all the problems in the shale oil industry with this low price of oil? it looks as if we're going to see much lower production by the end of this year and into 2016. So I believe the U.S. has peaked in oil production. We're going to see a decline of 33% or more within 5 years and 60 to 70% by 2025. So that's going to be a game changer for our economy and our way of life. And how we are able to transition is going to be very interesting going forward. So I just wanted to add that. But
well, and so lower production should mean higher prices, but we're going to have a crippled economy, correct? Is that your analysis on this?
Well, you see, this is what's interesting. There's like a 3 million barrel glut now. The world's producing 3 million barrels more of liquids, not just oil. I think oil is like 75 million barrels, but then we're producing 25 million barrels of liquids, all kinds of liquids. Well, there's a 3 million barrel surplus. That's why the price of oil is still so low. And China right now is filling their, they've built a larger, they've extended their SPR, their strategic reserve. And so they're filling it at this low price. But when that gets full, it's going to be interesting to see how that's going to impact price. But people say, well, if there's a surplus of oil, we don't have peak oil. Well, people need to realize that 3 million barrels, the market can't afford it. That's why it's surplus, because the economy can't afford it. If we could, we'd be using it. The problem is I don't see prices going to 100, 150, and 200 and being sustainable. I think the market can afford $100 oil when the Fed and central banks are propping it up with trillions of dollars in liquidity. I think the real market price of oil will be affordable if we take out all the manipulation and all the rigging and all the propping up. I think it's like $50 or $60 a barrel. So the problem is the companies need 110, 120 to bring on new oil. That's why you hit peak. The market can't afford expensive oil. And companies can't produce it because they'll lose money. So that's where we're at now. And it just gets worse going forward. So even if the U.S. is producing 3 or 4 million barrels, we really can't afford to produce more than that because the price is too high. And shale oil at 100 for the last 3 years, most companies didn't make any money. They had to spend so much on capital expenditures to continue drilling, so they didn't make any real profit at 100. It just goes to show you, even at 100, it wasn't a real viable enterprise. And so this is what we're facing, and that's the reason why I'll end with this. That's the reason why gold and silver are such valuable physical assets to own, because most paper and physical assets will continue to lose value because energy production allows them to grow. No. So if you're going to be an investment, I think it's wise to go in gold and silver.
That's amazing what you're saying, because basically you pointed out that the Fed made $100 oil affordable. You know, governments injecting liquidity made that affordable, which essentially brought about shale oil, because shale oil production isn't profitable until, you know, 90, $100. And now that it's below that, it's an industry that isn't viable. And that goes to show you the manipulation that we have with the U.S. government and governments around the world. But with that,
one more thing, Kenneth. You're exactly right. And I guess the more important thing besides the propping up, you see, if the Fed is propping up the market with trillions of dollars of liquidity, then we can continue going to the store, going to Starbucks, we can go to the movies, we can go out to eat, we can buy another house, we can buy a car. When they stop that, then economic activity falls. That's one thing. So they can afford higher prices with that. The other thing is zero interest rates. If you could borrow money at zero interest rates, you can do a lot of lousy investments, and that's what happened. A lot of lousy investments went into investing in the shale oil industry. So it was those two things that were happening. Americans could afford high oil prices because it was being propped up, and the shale oil industry could afford to continue drilling because people were investing money into the shale oil industry due to 0% interest rates.
Yeah, no, amazing points. Everyone, if you want to get more information on Steve, visit his website. I mean, you can see that he's got a wealth of knowledge, and he puts that information in articles multiple times a week. you definitely want to check them out. SRSrocco.com. Thanks, Steve, so much for taking the time to come on the show with me today.
Thanks, Kenneth. I really appreciated the time. We had a good time.